Hello everyone, this is Bill Hall for Money and Markets. It's Wednesday, September 3rd, and I'm pleased to bring you this market insight. Personally, I'm really excited to be on this podcast today, and that's because traditionally the week after Labor Day marks the beginning of the run to the finish line for the year on Wall Street. That's because most senior traders on Wall Street tend to take the month of August off. They're on vacation. So it's hard to draw any significant conclusions into August market actions. Now what we did see, and it surprised me a bit, was we saw the market, the U.S. stock market as measured by the S&P 500, climb almost 4% in the month of August. And 4%, that's a big gain considering that we're only up, well not only up, but we're up 10% this year to date on the S&P 500. So a big piece of that 10% gain so far that we're seeing on the S&P 500 or in the U.S. stock market occurred during the month of August, and it will be really interesting to see if we can hold on to that. Okay, let's jump right in here and look at our first slide and see what's going on in the market. Let's start off this run to the finish line for 2014 with starting with the big picture perspective. And the big picture perspective is that the world's central bankers are in complete charge of the world's financial markets. That's because they've had to make so much liquidity available to make the real economy function that the markets are reacting to that, and much of that easy money is spilling over, as we all know, into the world's financial markets. Now let's look at our second slide, and if you listen to last week's podcast, you'll know that I told you about this way of looking at the stock market in last week's podcast. And what it shows is that there are three, and only three, components of stock market returns: dividends, earnings growth, and change in the PE multiple. That's right, there's only three components to all of this that you hear about in terms of the stock market. So at the end of the day, you need to distill all of the information you hear and understand how it affects these three variables. Number one, dividends. Number two, earnings growth. And number three, stock market valuations as measured by the change in the PE multiple. And in last week's podcast, what I emphasized was the dividend component of the of measuring total stock market returns. When I focused on business development companies and talked about how dividends could drive stock returns on that particular asset class. What I'm going to talk today about is the thing that's most important to driving long-term returns, and that's growth. And so that's why I have earnings growth capitalized here on this slide. Earnings growth is what you need over the long term to drive the stock market higher and keep it moving forward at high levels. So far, what we've had is change in the PE multiple, or the price that people are willing to pay, that have propped up the stock market, not real, honest-to-goodness earnings growth. So if you look at our third slide, what you'll see is taking 2013. That was a year ago, I know, but it's easy to look at 2013, and then I'll quickly talk about 2014 in terms of our stock market return model. And what we see is that in 2013 we had a phenomenal year. The market increased 32%, but only 5% of that came from earnings growth. We got a little bit from dividend, about 2%, but the majority of it was the fact that people were just willing to pay more for stocks at the end of 2013 than they were at the beginning of 2013. It's no different than going to the store and seeing a pound of hamburger sitting there and paying a premium for it over what you were willing to pay at the beginning of the year. It's no more complicated than that. So what we had was that on a generally speaking and loosely speaking, on a price per pound basis, people were willing to pay 25% more for stocks in 2013. So you may be saying, so Bill, what does that have to do with 2014? Well, I don't have a slide on this, but if you looked at 2014's returns, you'll see that about half of the 10% return, that's 5% of it, has come from the fact that people are willing to pay more for stocks. So the fact that the market has increased a whopping about 42% over the last 18 months, most of that is due to the fact that people are just willing to pay more for stocks. So, and that is something that can go on for a while, but it can't continue. It's not sustainable. It will not hold the stock market at its lofty levels. So let's take a look at our last slide, and you say, what is an investor to do? What should an investor do in a slow growth environment? And what I'm recommending investors consider is companies that can grow their earnings in all types of economic environments, especially the difficult, slow growth world that we face today. And a company that you should consider adding to your portfolio is PepsiCo. Here we have one of the world's leaders in carbonated beverages. In fact, they're a market leader in beverages of all types. They're a market leader in salty snacks. PepsiCo stock's up about 10%, about 13% year to date. What you get when you buy PepsiCo is you get earnings growth of about 10%, which is a very strong rate of growth in a world where the U.S. GDP is only growing about 2 to 2.5%. You get a dividend just under 3%. So if you get no market revaluation, you could probably look at 13% going forward. And if we get some benefit of a bump in terms of the PE multiple, you could be looking at a 13 to 15% return. And at 13 to 15%, your money will double every 5.5 to 6 years. And it really doesn't get any better than that in the markets. So that's Bill Hall for Money and Markets. Have a great week, and I look forward to speaking with you next week.